This is a special edition of MacroVoices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of MacroVoices, here's hedge fund manager Eric Townsend.
MacroVoices All-Stars episode 16 was recorded on June 10th, 2019. I'm Eric Townsend. Santiago Capital founder Brent Johnson is back. Brent, we just had you on, of course, on the main MacroVoices podcast last week, and I'd like to follow up because there's been some new developments even in the few days since we spoke. First of all, Jeff Gundlach this weekend tweeted, "Dollar is rolling over. Gold up 8 days in a row. Don't envy the Fed, which announces in 10 days. Market is pricing 4 cuts, more likely than 1 by year end." So you've got definitely some people that are saying, hey, the dovish pivot has happened. The Fed is going to be cutting. This has to be the end of the dollar story. And certainly all of the people, and there's quite a few of them, who have thought that you and I got it wrong with respect to the dollar. They felt that the dollar has been in a topping pattern. They're screaming victory laps and jumping off the rooftop saying, hey, we nailed it. Look at the dollar. Brent doesn't know what he's talking about. It's all falling apart. Meanwhile, we've got all of this U.S. Mexico trade stuff that came out over the weekend, ECB talking about rate cuts. We can get into that. Is this reason to think, Brent, that the views that you and I have had about the dollar moving higher just might be wrong? Or is this really the buying opportunity that you predicted when we spoke to you last week?
Well, I don't know if we're to a clear decision on either one of those right now, Eric, but I do find it kind of interesting and funny. And to be quite honest, I actually enjoy it. I had a number of people come at me last week, saying, oh, look, the dollar's rolling over. This is it. The Fed's capitulated. The dollar's falling. Meanwhile, and at the time, when we spoke last week, gold was bumping up against 1350. And I had a number of people saying, it's breaking out. This is it. And I don't want to discourage people from doing that. I love the interaction. I love the banter. So, this is not me complaining under any circumstances. I'm just pointing it out. And but the fact remains that the dollar is still higher than it was at the end of the year. So despite the huge dovish pivot by the Fed, and despite all these other, Gundlach and other people saying the dollar's rolling over, it's still up for the year. So, there was a time a year or so ago where even the slightest bit of bad news would send the dollar falling. And now you can't really find much more, I guess, bearish news for the dollar. And it's still up. So, yeah, it's pulled back. It's bumped up against this 98 level 2 or 3 times in the last couple of years and pulled back. And, that's pretty stiff resistance. It's become pretty clear that that's an important level. But, again, we're still up for the year. At some point, I believe that we're going to break through that 98 level. And once that significant resistance is in the rearview mirror, I think people are going to be surprised as to what happens.
Brent, give us an update on what happened over the weekend with respect to the ECB and their announcements with respect to interest rates.
Yeah, happy to do that because, they did come out with they didn't make an official announcement, but the rumor was floated again that, the ECB was open to rate cuts. So, after the dollar had a little bit of a swoon last week and, gold made a big jump, Mario Draghi came out and basically on their official statement kind of maintained their dovish stance, but didn't say anything specific. But he made the comment that they had the authority and the ability to react again should they ever need to. And then over the weekend, in Reuters and in I think the Financial Times and in a couple other publications, this rumor was floated that the ECB was open to more rate cuts. And over the weekend, I actually sent out a post on Twitter, with a picture of all the G20 finance ministers asking the question to see what people would come back to me with is, if the Fed follows through and starts to cut rates, what in the world do you think the rest of these people are going to do? None of them have raised rates, or the ECB hasn't raised rates in 10 years. And, Japan has been doing, these extraordinary measures for 20 years, and everybody else is on an easy bias. And I just have a hard time believing that, should the Fed start cutting rates and making those other foreign currencies appreciate, that those finance ministers and central bankers are just going to sit back and take it. And then sure enough, we get this rumor floated by the ECB that they're open to more rate cuts. I mean, they're already negative and now they want to cut more. So if the dollar bear thesis is right in front of us, and if the dollar bears are going to be proven right, they should be proven right fairly soon. And so, I think if I was in their camp, I would be watching this very closely because I'm not sure that they're going to get much more firepower than they have right now.
I think that's a really excellent point, Brent. You and I could be wrong. It's happened before. But if we're going to be proven wrong, it's going to happen really soon. Because if we get through this, if the Fed announces that they're actually cutting 50 basis points, and that causes the dollar to take a little nosedive on the day, and it recovers, and we're back up to 98 2 weeks later, that, to my thinking, pretty much nails it at that point, that the dollar bearish argument didn't really hold water. And I guess if it goes the other way, we'll find out pretty quickly here. But Brent, I want to follow this idea around what would happen with other central banks through, because I see your point that if the Fed announced their first rate cut in a new cycle, the other central banks around the world could do the same thing, and that would mean that there wouldn't be any differential benefit in terms of interest rates that would contribute to the dollar weakening further. But what if we go through a full rate cutting cycle and we get all the way back down to zero on the Fed funds rate? I don't think that the ECB can follow tit for tat every step of the way there, because they would have to go to deeply negative rates in order to match the U.S.'s steps all the way down to a zero Fed funds rate. So at some point, does this decouple to where maybe there is a little bit of a rate differential argument?
Sure. And, I can't rule that out. Here's what I would say to that. This is what I believe would happen if that path were to occur. And again, like you said before, Eric, it's possible that I'm going to be wrong. I've been wrong before. I'll be wrong again at some point. And when I'm wrong, I'll admit that I'm wrong and I'll have to readjust. But it's my belief that even if the rate differential is arbitraged away by the Fed cutting more aggressively than the other central banks are able to do, to me, if they are cutting rates that fast, that means that the global economy, not just the U.S. economy, but the global economy is in a very, very bad place. And again, I think that the global economy is slowing. Again, my whole thesis for the U.S. assets rising is not because I think that there's a global expansion or even a U.S. expansion. I think U.S. assets go higher because things are getting worse, not because things are getting better. But if the world is getting worse and the Fed is cutting aggressively to address that, I believe the rest of the world is getting worse as well. I do not see a scenario where the United States goes into a downturn or a recession and the rest of the world accelerates. To me, that is just something that I just cannot get to. Now, if it were to somehow happen, again, I'll admit that I was wrong, but that to me is just a too far to go to think that the rest of the world is going to start accelerating as the U.S. turns down. So if we get into a situation where the Fed has cut aggressively, we are now down to zero rates versus Japan, Europe, and some of the others at negative 25 or negative 50 basis points, whatever it is, and that interest rate differential has largely disappeared. I think at that point, we're going to be in such a mess that the global economy is going to be headed down, that the U.S. is going to, and the dollar specifically, is going to start getting those safe haven flows, not because of rate differentials, but just because it's the best of the bad bunch. So even if that happens, if this rate cut progression starts, it will not surprise me if in the early stages that is bad for the dollar. But I don't think it stays bad for the dollar very long, because I don't think it's very long before the rest of the world starts scrambling for the dollars that they need to pay their dollar debts and to operate in dollars. And I think that gives the dollar a bid. So, whether we hit 98 again next week or whether it takes 6 months to break through it, I don't know. I think it comes sooner rather than later, but we'll just have to kind of wait and see.
Something that really has gotten my attention this weekend is if I look at how big that gap up on the S&P was on Sunday night, it appears to be the U.S. Mexico tariff agreement that has gotten better over the weekend that caused that. If you can have that big of a gap on U.S. Mexico, how much upside is there for the S&P if Trump and Xi pull a rabbit out of a hat and there's a U.S.-China trade deal after all, let's say, before the summer is over?
I mean, I think there's huge upside for the S&P. I really do. And again, I know people are going to say, how can you say that? We're at all-time highs. This economy is all central bank driven. Profits are falling and, revenues are falling and et cetera, et cetera, et cetera. And I get it. I completely get it. Again, my argument is not that the S&P or the Dow goes higher because things are good. My argument is that the capital flows coming in from overseas will drive it higher. And if this trade deal goes through, which, it looks shaky, but if for some reason it does, and if we are able to break to the top of the all-time highs and break through it, there's not a whole lot of resistance there. And people have been saying it can't go any higher for 10 years now, but here we are, right? And so again, maybe valuations get even more stretched than they are. Maybe the wild spirits or the animal spirits run even harder than they're already running. Again, I think that this is all going to end very, very badly someday. I'm just not convinced it's going to end yet. So I think that there's a real possibility that equities go higher.
Well, Brent, I can't thank you enough for a fantastic interview. We look forward to having you back in a few weeks to get an update. Meanwhile, please tell our listeners where they can follow your work.
Yeah, thanks again, Eric. Anybody is always welcome to email me. It's brent@santiagocapital.com. I'm pretty active on Twitter. You can just search Santiago Capital on Twitter, and I guarantee you'll find me fairly quickly. But always happy to come on, Eric. Enjoy talking to you and your listeners, and I'm looking forward to kind of an exciting summer.
Okay, Brent, well, it's great to have you on, and we'll see you in a few weeks. For the MacroVoices Podcast Network, I'm Eric Townsend.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices.